And George, you say for most of your mandates, you remain pretty much fully invested. When do you still start feeling a little bit more comfortable with this market? Because until that point, do we continue to just get the drifting and the lack of conviction in any sell-off and any rebound?
Yeah, all good questions, of course. For a fund manager, you just got to get comfortable being uncomfortable. The things we're trying to be predictive with future earnings, and we know that the valuation is much lower at the moment, and they've gone from the S&P last year 22 times to now under its 10-year average. It's under 16 times, and likewise in a lot of developed market equities. But the way to overgeneralise it is there's a desynchronisation in monetary policy. There are economies tightening for obvious reasons because of the inflation scare, and they've got good economic momentum before the slowdown. They've got good EPS momentum before the slowdown in aggregate. Household savings are high in North America and many developed economies. However, having said that, other central banks like Bank of Japan and the ECB will be well behind the curve. Bank of Japan would never tighten. ECB have missed the boat. We think core Europe will be in recession and verified later this year. And the UK is in the same boat, just a little bit delayed. So the desynchronisation in monetary policy, and again, China stands out on itself because it needs to do something very innovative from a fiscal and monetary sense to repair what's going on in that economy for a number of years. So on the back of that, we think that the US or North America and commodity economies like Australia would have a soft landing. And we believe a lot of the rate hikes are priced in at the moment, not for a hard landing, but a lot of the rate hikes. And my final point on this is that implied rate futures for the Fed funds were towards 3 a month ago and towards 275 in Australia. And now they're about 25 basis points lower. So they're getting comfortable with the scenario of the rate hike. And when you get to 2.5 real for the 2.5 nominal Fed funds rate, that will create more stability going forward. It's just the pain that we're going through at the moment is required to get there for more stability in the future.
The RBA has said that neutral for Australia is somewhere between 2 to 3%. Obviously, that sort of moves around a little bit. But does the change in government have any implications for the RBA if we do see a bit more spending around the margins, maybe a higher wage narrative and that renewed focus on climate investment?
Yeah, at the margin, it's a higher cost narrative and a higher cost narrative on healthcare. But the advantage the incoming government have is that they're a majority in the lower house and they don't need to do a deal with the Greens. And that is the biggest hurdle that they had to overcome. They got a bit more clarity to deliver what they needed. The concerns were, what do they do with AUKUS? And they're straight on the plane and they've got to reaffirm their commitment to AUKUS, the commitment to nuclear submarines, etc. And that's been important. But taking a step back, they are going to spend more on healthcare. They have promised real wage rises somehow across the economy. And one would think there's more regulation in part coming. But in the main, they've got a starting situation, the best G20 economic performance through the COVID period. Right. The debt is excessive, but relative it's quite good. So there's a lot of positives that they've gotten, and the tight labour market is a good starting point for them.
A lot of positive also coming recently from China news. I mean, especially on perhaps the review of the tariffs by the U.S., not to mention all of those specific measures to support the economy from Beijing. Our MLive Pulse question, do you expect to increase or decrease your exposure to China in the next 12 months?
Yeah, very quickly. So we've got an Asia fund, it's been around for 23 years. March quarter last year, it didn't hold top 10 holdings for the first time with China exposure. It was very complicated what they were doing and confusing for us. It's very hard to be predictive on future earnings in mainland China. Going forward, there's extreme value there. It's a hard landing that they've got for their economy. And we'd look and we'll assume there's an accumulation of Chinese exposure from a low base, but not to the same levels that we had, say, for that 2012 to 2021 period.
So what are your top calls at this point, especially if you have a rebound in China, perhaps? Then there are so many different economies across Asia that are dependent on that.
Yeah, so rising interest rates, desynchronisation, remember, with monetary policy, it's not rising interest rates across the globe. But generally, we say structurally the commodity cycle is strong and there's going to be cyclicality involved with that, but that's good for Australia. It's good for Canada, parts of South Africa, even parts of the APAC region, like, say, Indonesia, some parts of their economy. Rising interest rates and that steeper swap curve, even though it's a little bit flat over the past 2 weeks, it's good for diversified financials, and we like that. We like it with Goldman Sachs and Macquarie Bank as an example of that. global play, and then taking a step back, some sort of industrial exposure where there's no margin compression. The food inflation is going to put a lot of pressure in the developed world on generally good food suppliers, and that's an area that we're very cautious of for re-regulation as well in some parts of the world. But generally, we see that valuations are very compelling for the soft landing calls of North America and commodity economies, and we quite like that. And dividends are a good cushion for those growth at reasonable price to value plays, as we've never played into the growth at any price of technology.